Hello, everyone. As said earlier, that we are going to take a session on market updates. What exactly happening in the market? Market today is at 42,000 near about and 12,500 Nifty level. So, what exactly is happening in the market? Why market has gone up so much, and where we are looking ahead in the next in 1 year's time? I'm going to share with you. Today, we have gathered a lot of data points, so I will let my data speak instead of me giving my opinion. Obviously, I will give my opinion at the end. So let's go for the data and let's see what exactly is happening in the market front. Okay, so now if we see the data point right now, if you see the different parameters, what exactly you are looking at, like in October, we have a trailing Nifty PE of 31.90. Probably you have seen the different tenure which you have mentioned here. Now this 31.90, it's not deceptive. Why I mention is that out of this Nifty 50, you will find 10-15 companies where the PE is actually much higher, while the rest of the remaining 30-35 companies PE is much lesser. So the reason why market has gone so high right now is that there has been a huge investments in the top couple of companies from the FIIs level, as well as the retail investors and the institutional investors also. So that is the reason why it has gone too much high, and you're seeing the PE so much higher. But broadly, as I mentioned earlier, if you see the broader PE of the last 35 companies of the Nifty, you will find a much lesser P, which is ranging around 15, 16 level. Okay, so market cap to GDP is at 81%, which is a good point category. If you see the December 2007, where you remember the market has dipped from market has gone down. So and October also, you'll see the market cap to GDP ratio out there. So it is still very lucrative options out there. Capacity utilization is another data point. Like you see it is about only 47.3%. As I mentioned, you see the net FIIs flow. Uh, see that this net FIS flow is at all-time high, right? It's on December 2007 when it's an all-time high, and then today is also it is an all-time high. And if you see the Nifty 50 return in last 1 year and 3 years, you will see the return is completely muted kind of thing. It's 4% return in 3 years Nifty. And vis-a-vis if you see the Nifty 50 EPS growth, you will see the kind of negative returns that we are getting right here. So despite market as going high, the Nifty 50 EPS growth is negative, right? As far as the macro indicators are concerned, we have a negative GDP rate, which is about minus 23.9% in the first quarter. We are expecting, the government has already said that this year the GDP growth rate will be minus 8 to minus 10%. So that means in second, third, and fourth quarter, the GDP rate will be much, much better than minus 23.9% in the first quarter to adjust the number. Okay, so going forward to my presentations, like what exactly happened in the market, like global factors impact on Indian domestic market pre and post COVID period, reflected in high frequency indicator released by the Ministry of Finance, current macro trend, and 4 pillars approach of equity market analysis. We are going to discuss these points, all of these points by a data point. Okay, so you will be able to understand where we are heading to. So international factor, let's look at the international factor. Like obviously the factor which is going to avoid the US election, which is already over. I guess the Biden has already won, and there will be some legalities, but it will be settled down in 1 or 2 months time. The major international factor is the international oil price trend, trade flow, capital flow, international interest rate. We are going to discuss this: domestic and international political events, international currency movement, credit rating agencies views, and stimulus measures in corona period in all parts of the world. So those are the points which are actually will define where the international market will grow and vis-a-vis the Indian market. Uh, Oil and economic issue. There are two ways in which the oil shock weakens a nation's economy: through direct cost and indirect cost. The economy bears direct cost when the rising prices of imported oil cause a transfer of income from consuming to the producing nation. The indirect costs are caused by the rise in the price of oil related to the production input. Okay, so we have seen that there has been oil price has been muted for a couple of times, but going ahead in the next 4 to 5 months, you will see the oil price going ahead, going rise, and because of the oil price, you will see later on the data that we have a huge forest reserve, and our export import. Export import valuations are much favorable in our time because only of the oil price. But I figure out that in the next 5 to 6 months, the oil price is going to higher because if the countries across the globe are now getting unlocked situations. Although we have seen that a couple of European countries are into lockdown again, but you will see the next 2 to 3 months time things will be much stabilized. I expect a vaccine to be come out by next April May, and the oil and the demand for the oil will again increase. And when the oil price increase, you will see um, a lot of movement in the currency also in that front. Okay. Crude realities now, after remaining at close to 60, as I mentioned, after remaining at close to 60 a barrel a price year ago in the remaining part of this thing, and oil touched to extremely low level in March. Now, while it's like 25 barrel, okay, dollar a barrel, the reason we all know because of this lockdown and all those things. Now, based on the data pertaining to the oil import of India, every $1 a barrel foreign crude price, there is a gain of 12,000 crore that accrue to the India. Imagine that 60 barrel dollar price from 25 barrel dollar price. Now, how much India has gained in those times? Okay, if we estimate $18 a barrel fall in oil price in the last 1 year, then it will be more than a gain of 2 lakh crore to India in the last 1 year. That's much of gain India has done. Now, gold has that's one oil. Now, gold has delivered over 29% return in 2020 as of now, compared to the 25% in last year. In September, however, gold has corrected 4% in dollar terms in price. Like people who have already invested in golds, they might have gained the return. And by seeing the past return, people might be attracted towards investing in gold. But remember, if the oil price shoot up from here, you will not find a much favorable gold rally from here. Okay, so next 4 to 5 months, as I mentioned earlier, the oil price is bound to shoot up. Probably it will take April, May, June kind of thing, and then you will find the gold price stabilize a little bit more. As mentioned in the previous slide, benefit of fall in oil price and lower import due to subdued economic activity and movement result in trade account turning into a surplus in June. And as I mentioned earlier, in the current account deficit is also turning into a surplus hugely. You will able to see the data when I go more into technicalities. Trade balance in September, we have export. We have a growth in export after 6 months nearly. And why I'm going to show this data is that all the negativity which is there in the market, like we are in a 42,000, but economy is not doing good, and all these things we are expecting a correction. You will be able to find out after this data presentations where exactly we are heading. And the data point is not saying what exactly the common people are thinking. We have an export growth. We have a huge export growth after 6 months of fall. And trade balance Indian debt market follow the global crude oil trend very closely. Um, in a current pandemic period due to initial lockdown world over and then gradually opening, oil demand has remained muted and has resulted in fall in oil import price I mentioned earlier. Also, trade balance is basically favorable to India because of the huge fall in oil price. Okay. So that has become a huge gain. As I mentioned earlier, that India has gained 2 lakh crore in the last 1 year just because of the oil price falling down. $1 fall in oil price in an international market, India gained 12,000 crore. Okay. Uh, I mentioned already about the trend in gold and a crude price, and you will find a inverse correlation between crude and the gold. Okay, so this correlation you will see that crude and the gold movement out there, and this gold price is since the crude will increase, this you will find this gold will about to come down in days to come. So I personal recommendations will be don't put in all your buckets into the gold by seeing the past performances. Okay. Inflation and monetary policy, like oil is a very important factor. Like most of the people that tell me that India, that what's happening in the China Pakistan border and what's happened in the international politics, the most important factor when you look into the market movement is oil and inflation. So, okay, these are the two factors. If you see only these two factors, you will be able to understand where the market will head to. WPI gets influenced by the change in the international oil price, the wholesale price index. Whenever international oil price go up, India, being an importing country, gets impacted adversely. In a rising oil price situations, we end up importing inflation in the country. Like, this is a very important point. The import bill goes up, resulting in widening of trade deficit. These also impact current account deficit negatively, also resulting in deviation from fiscal discipline. Now, in a current environment, when the oil price in the international market remains soft and inflation also begins like benign world over, the central bank in all parts will get room to either cut rates, um, and due to pandemic, they're able to give a huge amount of subsidies to the different sectors. Like, when we see that, how can the government fund so much of health infrastructure in India due to the corona pandemic, and so much of subsidies that they're giving to the different banks, institutions, and people by way of those who are affected with corona, is because that they have made huge money through oil price reduction. Okay, so international oil price impact on Indian basket. So if you see the inflation right now, we have a little bit increase in the inflation rate. Now, this is important point because RBI has already said that the WPI, okay, so they have a target that WPI inflation rate has to be within 2% to 6% level. Now, in the month of as a whole, WPI, we are at 1.32%, and as a whole, CPI is a consumer price inflation. This is 7.34%. It's slightly increased. The CPI has increased basically because we have the food inflation, which is huge right now. The food inflation is huge because what is happening in the retailer and the distributors and the different mandis in the market, they're having a supply chain issues, and because of certain policies by certain mandis and retailers, they're charging a little bit extra amount, okay, giving the corona pandemic situation. The government is having a very close look towards this food inflation, and I think with next when 1 or 2 months time, you will see the CPI also coming down. The food inflation, you might be having a deep impact in your pockets of local grocery item, but in next 2 to 3 months, I am expecting this to come down because we have a better supply chain logistic available across India. You might have seen that there are we have difficulties in trains moving across freely across India, the local trains and all those things. So they will have a problem out there. But in 2 to 3 months' time, the CPI is going to reduce, and WPI as a whole will further reduce. So fuel and power, like as I said, oil price is negative, so we have negative inflations. We have manufacturing, we have very slight primary good is little bit higher side. So this is going to reduce, and when the CPI reduces, it will obviously impact the WPI, and you will see the further interest rate cut in next 2 to 3 months time. So I am expecting in January, if not January or in March, RBI monetary policy, you can have a further rate cut of 25 basis point, and if there is a rate cut happening, that will give a good yields towards that if you're invested in debt funds, or and it's a good boost for the economy also. So this particular figure, this particular chart is giving me a clear indication that we could go ahead with another rate cuts in probably in January or a March cycle. Okay. If you see the inflation in developed economies, now why I say inflation, because if you go to the history of any country's economy, you will find this is the only parameter which drives the market. Rest all are coming and going kind of thing. Like, inflation is most of the country. If you see this US, UK, Eurozone, and Japan, it is near about 1% or less than 1%. Okay, so since the inflation is much less than 1%, the Fed or the central bank of the particular country will have a huge scope to pump in more money in the economy, right? So when they pump in more money in the economy thrives, and that's the reason why US economy has gone all-time high despite having a corona impact. Why the European countries are doing an all-time high. In Europe, despite they're having a lockdown in London and couple of places recently, you will not find the market coming down hugely because the interest rate is very, very low. So if the real interest rate is very, very low, general people, like, they will not find to invest in FDs or fixed income securities, and they will put money more into the market. Putting money into the fixed income securities where the interest rate is low or a negative is a guaranteed loss. Where you put money into the equity market, probably you will gain something, right? So that's the reason you will find that because of this interest rate coming low or remaining low, you will find a huge money being pumped in by the central bank of different countries, and this trend will continue for the next 2 to 3 years, because Fed has already said by 2023 they are not in a mood to increase the interest rate. Okay. uh, I have already said about this interest rate and trend in the stock market. um, so if you see this current and previous rate, I have already said that interest rate is already low. It is like in a couple of countries you will find it's minus also, Bank of Japan and all those things. So imagine a situations when you have a minus interest rate, or like 0.2% or 0.3% interest rate. Why will you put money in the banks and FDs and all those products? You will put money in equities, right? You'll put money into the market, because with the interest rate of negligible like 0.1%, and with an inflation of 1%, like you will have a real return is negative. Your interest rate is 0.1% and your inflation is 1%, so you are getting a minus 0.9% return annually. So that's devaluing of money every year. So that is one of the reason why people are putting money in the market aggressively across the world. Coming back to the Indian market, we have seen the FIIs actually drive the market in short run. If you see the data point out here, I have seen given you the dates as well as the equity. October we have taken the first week because I have not get the data point fully out here. So if you see the data point till September, okay. So if you see the data point till September, um, see, in March, when the corona happens, we have a huge outflow, and that's why the market has fallen from all-time high to 8,000 level in Nifty. And if you see the September and August, September also, did we have increased this thing, and total. If you see the total figure, September we have a negative, but in October the end, I have not quoted data. It is again to the huge positive side. So there is a huge incremental flow of FIs in India. Apart from this FI's incremental investment, we have seen a huge investment in last 3 4 months in Geo and other companies by Facebook, Amazon, Google, and all these big companies. They have made a huge strategic investment in India, and which is actually a long term perspective. Okay, so FIs are coming back to the India with a big rigor, which is evident from the data point. That's again a data point. We have seen that we have a V-shaped recovery. Like in February, the market was at 12,500. Today, it is again at near about 12,500. It dipped to the 8,000, 7,600, 8,000 level in the March. And see the data point out here. So it is near about flat. So market is you will able to understand, because with the more data point, market is not costly right now and not cheap right now. It is exactly the level what we are at January, February right now. So we are not costly, we are not cheap, and that's a valuation parameter of market right now. So don't think that market is at 12,500 level right now, and we are at a huge costly affair, and market is going to correct deeply from here. I don't see a huge correction from here. Uh, Indian currency movement, well, I will skip for here because I have mentioned a little bit in the earlier also. Forex reserve, I already mentioned. See the kind of forex reserve we have. 1 year ago, we have a forex reserve of this, and see this is the kind of forex reserve. This exactly happened because of the oil price, which I mentioned. And since we have a huge forex reserve, the government has a huge bandwidth to spend so much of money for the development of the health infrastructure, for the economy, for the industry as well. Okay. Uh, Now, equity market, why the market is buoyancy? As I mentioned earlier, there has been a huge inflow from the FIs, which I've already mentioned in the data point, and those FIs inflow has basically gone to the top 12 to 15 companies of India, and that's why the share price of the top 12 to 15 companies of India has gone high. But if you see the huge companies database, you will find the share price are still low in the 5 years time. There are a couple of companies. I'm not going to mention any company's name here. There's a very good companies, fundamentally very strong, but their share price is still low. Only couple of companies, the top level, we have seen a huge inflow. Fiscal and monetary. Now, why the market has gone up? That's one reason. And a couple of other points which I'm going to mention out here is that fiscal and monetary stimulus announced by the government of India and RBI addressing both the demand supply side to relief from the economic relief to the economic prospect hit by the COVID pandemic. Strong external front. We have seen oil price coming down and all those factors. we have a huge bumper Rabi crop and Kharif crop going season, and great expectation of Rabi sowing now. Now, when I see the rural economy, bumper Rabi crop and Kharif season, further going ahead, you will see the data point. We have a huge tractor sale happening. We have a huge rural development which has happened in the last couple of 5-6 months, despite having a corona. Rural economy has thrived in India, and that's one of the reasons why you will find that don't have any much problem. Also, despite having a supply side problem, we don't have a much problem food side, because in food inflation is basically in the supply logistic issues. In a long-term growth prospect mainly intact and possibility of attracting many businesses from outside the country, reforms in progress, stable government, availability of land, laborers, and a recent development in the international market vis-a-vis China has made Indian market as a very attractive market. Okay. So we have already the V-shaped recovery, great fundraising activities in Indian company month of July, August, and September, and we have a huge amount of IPOs and other fundraising activities lined up in the next 4 to 5 months, and that is the reason equity market is buoyancy. And added to that, we have a lowering interest rate, and there I am expecting, as I said earlier, that we will again have a reduction in the interest rate probably in the month of January or in the month of March, that will again push market upside. Data released by the Finance Ministry suggests that there's an improvement in the trend of consumption of petroleum, railway freight, power, e-way, daily electronic tolls, and all this tractor and two-wheeler seller. I'm going to quickly show all the data point. You will find all other parameters that we are lagging, and we are actually make a huge progress despite having a corona and impact. The data point says that we are actually make a huge progress, and some data points are better than 2019 also. So that's surprising. I'm going to show you the data points. Like, as I said, the V-shaped recovery, the power demand in January was 3.9, it was 4.6 right now. Okay, so I want to mention is that there are a couple of power companies where you will find the P ratio is at 5 to 6, right? Imagine the Nifty P is 31, and a couple of big power companies that P ratio is 5 and 6 or 7, and whereas you see the potential. Whereas a couple of like consumer durable company like fan manufacturers, AC manufacturers, those companies P ratio is like 35, 36, 25 kind of thing. So do you really mean that what is the basis of those companies? Is the power, right? Power is the base. So what I mean to say that if you are looking into a Nifty and Sensex at that level and thinking that it will get corrected, think from the perspective of the power companies. Their PE is so low, and we have a huge increase in PE demand, in power demand. So do you think that this company will remain at that level? So there is a huge prospect but this particular example is true in every industry. There are a couple of companies which has grown up, and a huge amount of companies which are fundamentally strong. They are still very, very low level. Okay, so that's one thing. As I mentioned here, this power demand, and then the indicator power consumption, as I already mentioned, is exactly in sync with the power demand. You see the January data, you see the today's data. So we have increased tremendously in power consumptions, which actually say that people are actually working, industry and all those things have started moving up. Petrol sales is another important data point, which actually tells us that the movements happening in truck, trailer, commercial vehicle, and the personal vehicle front, and how people are traveling. So we are actually back to the previous level of January right now in September. If you see the railway freight corrections, it is again, we have actually increased from our January level in September. Okay. If you see the cargo traffic movements in vis-a-vis 2019 and 2020, you will find we are near about to that level. Okay, so all the data points are in different port, like Calcutta Port, Paradeep, Vizag. We are nearly near about to the 2019 level in September month. GST collections, well, people say that there's not been business activity happening, but if you see the GST collections in the month of September, we have like 96,000 crore, which was actually pre-corona level. We were like 1 lakh 10,000 crore. So we are nearly at the same level. at December, January in the GST collection. A GST collection gives us a clear indication that where we are actually heading to and how the industry is performing, because today everything is transparent. Okay. Uh, as I mentioned, you see the GST collections out here, FY 2021 and FY 20. You will see in April it was this much, 32,000. It was 95,000 in September right now. Okay. So if you see the data point in May last year and today in September, we are near about same. As I mentioned, 110,000 was an approximately in 2019. We have 95, 96,000 level, and going ahead, it is going to touch the numbers very soon. And this clearly indicates our common general perceptions that industry and business are not happening, which is not true from the GST collections level. ETC count and collection, it is a highway traffic movement. If you see the data point, again, it's saying that highway traffic has moved back to this January, February level. E-way bill, again, I have seen the data. So all the data points, which e-way bill collection, you will see all the data points are giving a clear indications that we are going back to the December, January level, that is pre-level, and that is the reason why market has gone up to that level exactly. Two-wheeler sales, which actually tells a lot of people are saying that they're not having a job, they are struggling, but the data point of two-wheeler sale is saying different. In September 2020, we have, if you take the Hero MotoCorp, okay, so that's the largest company in India, they have 697,000 two-wheeler sell, whereas in 1 year back, it was 6 lakh sell. So two-wheeler sell has basically been driven by the small cities and rural areas. And as I mentioned earlier, we have a huge bumper Kharif crop, and rural economy has not been affected much by the corona, which is evident from the two-wheeler sales. If you see the next slide, which is probably a tractor sell, I will show you. Um, you will see the tractor sale improvement movements. You will see the September data point. See the September data is 72,000 level. In March, April it was 12,000 level. So we have actually improved huge in tractor sale. A huge demand in tractor sales. It's the sources from TMA, Tractor and Marketing Associations, which clearly indicates the growing demand and trend in the rural economy. Again, this is obviously retail transaction in UPI payment, because most of the people has gone back to the digital modes, which is bound to increase. Nothing new in this thing. Now, what is happening is that despite all this data point, a lot of people are saying that the real economy, which is visible, is having a complete disconnect with the market economy. Now, there is so much of liquidity in the system, in the global economy. That's why the stock market is very buoyant, and it's definitely a disconnect with the real economy, right? So, despite having all this said, that RBI governor has said this point, and we go with the reason why the frontline indexes was 26% up. However, in the same period, GDP has contracted to 24%. The important point here is that April, May, June, we have a GDP contraction of minus 23%. And in the same period, the index has gone up by 26%, right? So we have seen the index coming from 7,600 to like 12,500 right now. And but how this thing has happened in the first quarter? Reason: market is forward looking, as I mentioned multiple times, unlike economic indicator that comes with a lagged effect. Q1 GDP contracted due to the most stringent lockdown measure adopted by the government of India, as per the research conducted by the Oxford University. Post unlocking the economy in different stages, economic activities have picked up as evident in various high frequency indicators which I have shown you earlier. Market is now forward looking to better GDP growth prospect. I showed you earlier, I have told many times that market are obviously forward looking at any point of time. Minus 23% GDP in first quarter and government projection of minus 10% in the entire year. That means second, third and fourth quarter, the GDP numbers will be much, much better than the first quarter. And since the GDP number will be much, much better than the first quarter, and all the parameters which I have shown you earlier are showing a huge V-shaped recovery, the market has already moved up. Understand, market moved up because they have expected this. Their market is forward looking and they're expecting the market to open up more in days to come. According to the estimate of different global agencies, future outlook growth prospect in India, there is going to be an improvement in subsequent quarter. And for 2021, the economic contraction might be close to 10%. So market is looking forward to better GDP number in future and discounting that. One of the reason, despite in the first quarter, we have a minus GDP number, we have a plus index performance, because GDP number comes from the past data. Market go, behave, react from the much forward-looking future data. Uh, Now, market discount future and a forward looking, as I already mentioned, I'm going to reiterate this point. Second reason is that we can attribute to disconnect with the market represents stronger part of the economy, the formal, organized, and high on technology businesses with strong balance sheet. Therefore, to the extent market do not fully capture all segments of the Indian economy and hence disconnect. Uh, GDP as it includes all gross domestic product, while stock market, basically Sensex and Nifty, they are constitutes of 30 and 50 companies respectively, and those companies have a strong balance sheet, and they use strong technology, and that's why index sorry index do not represent the entire economy. So that's why you will have a disconnect. Like there are a couple of small sectors which may not be performing at as such, but you will see, then you will be thinking about why the market is going high. You understand GDP means the huge, inclusive of everything, whereas Nifty and Sensex is like 30 or 50 companies. Okay. The third reason that can be attributed to a disconnect is the loose monetary policy of central bank world over. As I mentioned earlier, there is a huge liquidity in the market. um, so all the central bank across the globe, they're pumping so much of money in the last couple of months that people have actually taken out those money, and put those money into the market rather than you spending on towards different goods and commodities. To continue with the point, reason for the disconnect, in a study done by the Swiss Great Swiss, there are some findings regarding the nature of the business in the respective market share economy. 50% of the companies that grab close to 42% of the market capitalization are entering into informal sector and penetrating into a new market. And this segment is not effective at changing the prosperity of the economy. Like example, a biscuit manufacturing business. Do you think it makes a huge difference with Corona and not Corona? Noodles manufacturing example of this segment. 14% of the companies that are close to 25% of the market capitalization are dependent on global development, and that to the extent is shielded from the development in a metal and IT business would be example of this category. 3% in number, 7% market capital represent business that are growing at the expense of others and grabbing the market share. Telecom space and private banking grabbing the share of NBFC would be example of this. This is a very important data point. 26% of the companies that represent 22% of the market capitalization do not see disconnect with the prospect of Indian economy. Banking and construction space would be example of this category. So I want to carefully study this particular slides, and you will be able to understand the kind of companies behavior vis-a-vis the market capitalization that they have. uh, well, the couple of points we've already discussed: GDP growth rate. We have fall in the GDP growth rate. We have contraction in IIP. We have earnings growth which are muted for the last 4 years. Those are the actual the real economy. That's a problem which we have. We have a lower credit uptake. We have a fiscal deficit. We have a no medical solution as yet. So there is a no medical solution of Corona. We have a fiscal deficit. Imagine current account deficit is different than a fiscal account deficit. So we have a fiscal account as a rise as tax collection got impacted during lockdown, and expenses went up due to stimulus measures by the government. Okay, but we have seen the GST collection is coming up now. We have a lower credit offtake. Although the RBI is giving huge money to the banks, banks are not lending it freely towards the needy sector right now. We have a earnings growth of the majority company are muted. Although you have seen the ICICI Bank has reported a huge record profit in the last quarter. Okay, we have a negative growth rate in GDP number also. So all this factor are disconnect, right? So this is normally people's mind that when all this factor disconnect, why the market is going high. Now, this data point, what I'm saying is the first quarter data point. Now, if you see the next quarter data point, like June, July, August, or September, October, November, these all numbers will go in a reverse direction. Medical solutions, you will next to 4 to 5 months, you will have a medical solutions. Fiscal account deficit, we have already shown that the GST number has increased tremendously, and next 2 to 3 months, you will find it go back to the 2019 level. It's already moved up that level. Credit offtake, the government has already taken a lot of initiative. You will see the bank coming up aggressively towards lending people. Earnings growth, and that's the one point that is going to impact it. That will take a little bit longer time because, as I said, that when the credit offtake increases, the money comes to the market, then actually the earning growth will start showing up. Okay, the couple of rural based economy company which is earning growth is better off, but normally it does not increase, but it is going to increase in days to come. In next 4 to 5 months, you will see, because all the parameters which I mentioned earlier are showing a very positive sign. GDP growth that I already mentioned is going to have a much better than the first quarter which I've shown earlier. So that's the so that these numbers are actually in the past. Like future numbers, market is already anticipating that future numbers. So that is why it has gone up. Industrial output contract to 8% in August data point. If you see the growth in major industry, we again have a V-shaped recovery. Now we are normally back to the January-February level. Contraction in IIP has moderated in August due to the easing of lockdown and gradual resumption of commercial activity. Manufacturing contracted by close to 8.5%, mining by 9%, electricity with an improvement in contraction by just 1.8% due to higher activity. Okay. Uh, Industry group and use-based classification performance highlight. If you see the mining industry, August, and you will see the data point, you will able to understand that we actually have an improvement. Although it is negative in August, we have an improvement in all the parameters from April to August. And if you see the only August sector, this is the average, this is the particular month sector. So you will see the improvement in the August, probably in September, October, November, this data point will much improve from here. I don't want to mention is again and again the contraction is slowing down, retail inflation surge, food inflation spike. This will again come to close. This will again reduce. As I mentioned, food inflation, retail inflation is bound to reduce in next 1 or 2 months. Bank credit growth at 5% in the September. Bank credit growth, I already mentioned that this is the one factor will RBI and the government will push towards improvement in days to come. And credit growth, again, I've mentioned already. Negative sentiments due to muted passenger Nifty and negative EPS growth. Uh, this has been there for the couple of months. You will see the September 1 year return, and you will see the return. In Nifty, 1 year return is still lesser. You see the Nifty, there's a huge misbalance between EPS growth and the return that the market is having. So this will get it corrected in the days to come. Now, as I mentioned, is that where to invest right now? Now, what are the sector that is going to invest right now? I've already mentioned earlier is that despite market being at 12,500 level or at 42,000 level, we are actually not having the full potential of India as a whole and all the activities that have been happening. So most of the money has gone to few companies. There's a huge opportunity lies in the value segment right now. When we talk about the value segment, you need to pick up companies which are fundamentally good, which are doing goods there, but their balance sheet and performance and share price are totally is not in sync. If you see the couple of companies, as I mentioned, power companies example, their P ratio is very low, and so they are bound to increase. So you need to pick up the right companies right now, and if you really pick up right companies, a lot of companies are trading at much below price, and you will get a huge momentum. Despite market as an all-time high, I don't see there's a huge, there's a deep cut will happen from here. And there's a huge opportunity lies in a whole lot of companies that are available in Indian stock market. Okay. We have seen different industry-wise performances. These are the Nifty 50 constituents gets chunk. Your financial services like constitute 33%, IT, oil and gas, consumer durable, and automobiles. So this is the chunk that Nifty is comprises of. Financial services include all the banks and all those companies. The bank performances are still been muted. So you will see the big banks like SBI and all those banks will started coming up with results which will push up Nifty further. Oil and gas will have a Reliance and all other companies which has performed extremely well. In banking sector also we have seen the retail bank has performed, the corporate banks have not performed. So On a nutshell, I close my webinar today. On a nutshell, as I mentioned in my data point, is that if I go for the summary, market is forward looking, and that is the reason market has gone up despite the GDP number is coming low. We are going to have a vaccine probably next 4 to 5 months time. US election is near about clear. There might be some problem in next months or so in clearing all the disputes that been happened between Biden and Trump, but it is very clear evident now, and the GDP numbers which going to be better off than what exactly happened in first quarter. And all the numbers which I've shown earlier are we are having a clear V-shaped recovery, and that is why market has also responded in a V-shaped recovery from here. I am seeing I will not be much surprised if market reach to 16 to 17,000 level in 2023. So that's a broader market. Uh, as a whole, there are a whole lot of universe of stocks which are available at below very very cheap prices, which you can actually look out for. Do your own analysis and study and invest there. Thank you all for listening to me. To reiterate that this webinar, this seminar, data points we have gathered from different. We do not constitutes any recommendation to any particular stocks out of this webinar. If you want to invest, you can consult and you do proper due diligence and invest. That's a regulatory requirements that we used to do after every seminars. Drop by any query that you have in the link which I've given in the chat options below. And I will be coming up with a ebook this month for markets update in the last 3 months and 4 months and last 6 months, what has exactly happened. Do subscribe to my Facebook channel and to get regular updates and next market updates. Thank you for listening.